The Standard Bank Group has released an equity strategy report on Nigeria. The report reviews not only the equities landscape of Africa's largest economy, but also macroeconomic metrics for investors. Joining us to discuss the report is Muyiwa Oni, Regional Head, Equity Research West Africa for Stanbic IBTC. Muyiwa, very welcome to have you. Good morning.
Thank you for having me, Richard.
Great stuff. So your report's robust. I've enjoyed reading it. You talked about the medium-term economic growth outlook for Nigeria being a bit challenging. Can you elaborate further on that?
Yes, so if you think about economic growth over the past 10 years, I think we've averaged around 5%, or over a decade ago, averaged about 5%. Outlook has been more difficult. So we still haven't been able to get past the recession from about 2015-16. COVID has complicated issues now, and so we're in an environment whereby government is struggling with revenues. So in recent times, production has been capped by OPEC, and so government has to borrow more. There's clearly challenges with addressing infrastructure gaps, and then you also have an environment where FDI continues to dwindle as well. So in the past, that would have complemented the government revenue position, and so you have a confluence of challenges that is making the environment more difficult, outlook more difficult as well.
Understood. Now, let's put this up here. We've got some sector calls, because again, this is an equity research report, but of course, you're talking about macroeconomic issues there. So you made some sector calls in the report, and let's see here. You've got, I believe, your overweight. Yeah, there they are. Overweight cement. Overweight banks, neutral oil palm, and underweight consumers. Let's start with cement and take us through why you're overweight on cement.
So for cement, I'd say for some odd reason, you continue to see volume growth, even with the difficult environment. So last year, the cement companies were still able to push through growth. And if you think that there's some elements of economic recovery, outlook should be a bit more positive. And I think what the cement companies have also been able to do is to push through higher prices, even with the difficult environment, with the high inflation environment. They're still able to execute that. So that should support earnings growth. And so that puts that sector in a more favorable position than a few other sectors. So the consumers, for example, that were underweight, the disposable income and continues to be difficult for the average consumer. The companies themselves as well, the consumer companies haven't really been able to raise prices as much. So I think this year we've seen some elements of price increases coming from the brewers, for example. But overall, if you think about the operating cost and how that has been growing, they haven't been able to keep up with price increases, and so the outlook for earnings is a bit more difficult in there. With the banks, so if we expect the macro environment to improve, concerns of asset quality deterioration diminishes somewhat, and so the outlook in that space improves. With rising interest rates, margins should start expanding again. So you had a situation late last year into early this year where interest rates on government securities collapsed to less than 1%, and so right now we've seen a considerable increase in those, and so ultimately that should be supportive, particularly for banks that are able to keep their funding costs low.
And does that, for the banks now, is that tilted towards the tier one names?
Yes, so to a reasonable extent, those. And so if you look at their profitability levels, the efficiency levels as well. So they have stronger ROEs, have much lower cost-to-income ratio. They're able to keep their margins, their net interest margins higher because of their much lower funding cost. And so overall, these names, to a reasonable extent, have consistently been able to deliver better than cost of equity returns. And so that's why even when you compare them with the smaller banks that have lower valuations, they still look attractive from that point of view, whereby you have higher ROEs, and so you can justify why price to book would be higher.
Great stuff. All right, so that's cement. Gone banks now. Oil palm. I think you're neutral on that, yeah?
Yes.
What's the reasoning behind that?
So for the oil palm sector, commodity prices globally has been supportive. So you've seen global oil palm prices stay reasonably high. And our view is that if you look at the price performance of the oil palm stocks listed in Nigeria, that positive news has been priced in. So in the report as well, we did a 10-year return profile for quite a number of the names, so about 30, so more like the NGSE 30, or about 30 very well liquid names. And you find that the oil palm were able to deliver stronger and positive returns in dollar terms. Unlike, I would say within those names, I think we had just about 5 or 6 that were able to deliver those. I think GT as well was one of those. Nestle, Stanbic, and Okomo Presco both stood out from that point of view. And I think what's helped, so there's been a combination of issues beyond higher commodity prices. You've seen policies that have been far more favorable to them. So if you think about the border closures, the restriction of FX for oil palm imports as well, that's been supportive. And our view is that it's reasonably priced, in particular when you look at the valuations of these names.
Fantastic. You pointed out that foreign direct investment since 2014, pretty much almost collapsed, right? That how impactful is that? What can be needed to bring back FDI, foreign direct investment? I think we even got there's an image from your report where you show we're looking at different countries, and Nigeria in particular is down. So
So it's collapsed, to your point, from average of close to $5 billion to less than $1 billion currently, and if you compare that to, so you have an environment where government revenues are low, you need investment in infrastructure, you need to create jobs as well. In an ideal situation, you want to drive investment, a combination of domestic and foreign investment. But we've seen a collapse. One might link it to the difficult macro environment, but I'll say also policies haven't helped as well. So if you think about announcements of fines and even fines as well, we've seen it much more heightened in recent times, unlike in the past. And all those make investors, both foreign and domestic, a bit more nervous. And so that caution, I believe, is what we are seeing in that considerable decline as well.
And you pointed out that as far as COVID is concerned, there might be concerns of a third wave. What can you elaborate on what you talked about there?
So I think for us it's really more, so not necessarily the third wave in itself per se, but more a case of what government does in an event of a third wave. And I think the reason why that point is important as well is that when you think about the first wave and government reaction, the lockdowns and how that had a difficult or had a negative impact on the environment, our view is that it's difficult to see how we're able to survive that as well. But if that comes into play, then it dampens the outlook for a recovery in the economy.
And then you talked about the Dangote refinery and NLNG, Nigeria Liquefied Natural Gas, being possible game changers, which was positive points in the report. So can you expand on that?
Yes. So the point we're trying to make as well is that, so in spite the gloom, given weakness in the macro, weakness in FDIs as well, you're still seeing some elements of positivity, particularly with, so one on, I would say from the headline and a more global point of view, a stronger drive from the government angle to drive backward integration. And some of the positives we had seen in the past is in the cement sector, where we used to be considerable importers and now we're net exporters of cement. I think rice, we're still working towards improving that. But with the Dangote refinery, and I think with other announcements as well, so I believe BUA is also talking about investing in a refinery and setting that up. Ultimately, you have a situation whereby we now become net exporters of refined petroleum products, unlike currently that we're net importers, and it accounts for, I think, about 30% of our imports, FX imports as well. And so with this, based on analysis done by the IMF, it improved the trade balance of Nigeria annually by about $2 billion. And so if you think about the pressure it eases on foreign reserves, for example, That's clearly positive. And beyond that as well, their estimate on the Dangote refineries adds about 30 to 40 basis points on GDP as well. So and that's really more driven by the types of ancillary businesses that could drive in the petrochemical sector. So if you think about the reforms we saw in the telecom sector, for example, and how that had a much more stronger ripple effect on the economy, I think it's that the IMF is trying to assess. So it's clearly positive with the Nigerian liquefied natural gas in Train 7 as well. Expectations is that I think total cost of that is about $10 billion. Direct impact on the Nigerian economy is about $2 billion. And then it also increases our gas production by 35% as well. So ultimately, much more positive for FX revenues, for revenues for the country. So if you think that there are still these positives that could, if well executed, have a positive impact, hopefully that also drives and attracts more investment as well.
Fantastic. I do want to ask you about debts. Where we are right now, there's been approvals for more borrowings. I know we're going to approach the Euro bond markets and so on. What's your feeling on where our debt levels right now and what the outlook is?
Yes, I suppose it depends on what you look at, right? So with debt to GDP, most people say it doesn't necessarily matter, right? Particularly if you're not able to monetize that GDP. So it's low from a debt to GDP perspective, but from a debt service to revenues perspective, it's considerably high. I think as a Q1, our estimate is it's around over 80% or so. And so if you consider that for every 1 naira or every 100 naira, 80 goes to paying debt, additional debt becomes a challenge. And I think for me, from a foreign debt perspective as well, because you can't print dollars, it makes it a bit more difficult, and risk of default if you don't have those revenues increases, unlike domestic debt where you can always print naira. Maybe the negative impact is higher inflation, but you still have that control, and elements or risk of a default is considerably low. And I think also if there are views that over time interest rates would rise as well from a global point of view, you're better off raising this debt now than later, given that rates could rise and then you'll be saddled with higher borrowing costs as well.
Real quick, I think we're going to go by a minute ago. I really want you to touch on inflation. Do you see that decelerating over time?
So I think there's been some elements of deceleration already, and the view is that off a low base, we still see risk on food inflation, more because of the insecurity challenges we've had and how that could continue to have a negative impact on that. I think the bigger concern is core inflation. So whilst you're seeing a reduction in food inflation, core inflation is rising. And one can argue that maybe it's also some reflection of some level of easing by the central bank or by the Monetary Policy Committee. And so that, I think, kind of creates a risk as well to how the central bank balances inflation, managing inflation and economic growth.
Fantastic stuff. Muyiwa Oni, Regional Head, Equity Research for Stanbic IBTC. Thank you so much for taking us through your report and for taking us through the macroeconomic variables in Africa's largest economy. We really appreciate having you on the show.
Thank you.